Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're going to take a look at some more earnings. This time it was Realty Income, ticker O, the monthly dividend stock. And we have the graph here. I, as with all earnings, have pulled the numbers from the earnings report and we're going to take a look at whether or not they're on track for the year or if things need to change. But for just a refresher on how things stand with the stock, we've got our margin of safety in green, fair value in yellow, overvalued in red. And then we've got some lines of support and resistance scattered throughout. This is a stock that likes to trade in the mid 50s to 60s range and pay dividends out monthly that they raise very often. Not massive amounts, typically amounts of like half a cent, but those half a cents can add up when they do it multiple times throughout the year and you're getting paid every single month. So this is a stock I own quite a bit of. It has been on our buy list, which looking back, it was a very early stock that we rated. If you're looking strictly at the dividend aspects, it's a decent stock. It's paying over 5% right now. But if you're looking at the value and everything else, I don't know if it really should be on the buy list. But let's get into it. It's currently just trading within a range between the margin of safety and the fair value. And that's the main picture that we get here. There's not any crazy trend. I mean, if we were to draw a trend line from the two bottoms here, it would have already continued underneath that trend. So there's nothing there. It's really just a range bound stock, which is nice for trading and for a safe investor, but not the best for someone who's looking for some nice returns over time. So let's get into the numbers and see what's going on here. We see that they are just over halfway on the revenue, so they might come in a bit higher on that metric. The total expenses, they've spent a lot so far this year, and it looks like they're doing some acquisitions, so that number will likely come in pretty high, but that's what you would expect from a company such as this, where they buy buildings and essentially as shareholders, we are owners in those buildings and getting paid out a portion of the rents. So far, their earnings per share, they've brought in 63 cents. They're expecting $1.34. They might see a bit of an uptick as the year goes on, so we can leave that where it is. And the same goes for the net income. They're at 45% of the goal that we would be expecting from the company, and they could definitely bring in a bit more in the later months of the year. So that is nothing too crazy. Shares, they still have some shares to issue. If they're going to continue on the track like they usually do, they do issue a lot of shares, but it does help to keep the dividend value stable and it helps them to raise cash to buy more properties. So in this realm, it's understandable. And I actually broke it down here because I wanted to see if them issuing shares was like really diluting the position of us shareholders. And this is what I came up with. So this would be the market cap of the stock. And then the number below it is the multiple. So right now you are paying 11.65 times revenues for that market cap. And historically, this has actually been a number kind of on the decline. In 2019, that was 15, then 12.5, then 14.26, then 11.6, and now it's at 11.65. So you would be expecting this number to be climbing, where if they were really diluting us as shareholders, we would see a greater gap. We're paying a higher multiple for the revenues, but that's actually shrinking. So that could mean that the stock's undervalued, or it could just mean that the market is less interested in this type of company. There's fear of commercial real estate, and there are very high interest rates. So a stock like this where you're getting paid 5.2% dividend, your money could be safer. You'd have less risk if you were holding it in some sort of CD or savings account. And so some investors are kind of scared. But should we be greedy when others are fearful? That depends on how you want to manage your portfolio. Earnings yield is not impressive, 2%, pretty low, but you don't really want them to have super high earnings because they're required by law to pay out the majority of those earnings, about 90% of them, as they're structured as a REIT. And they want to hold that payment stable for investors where they can make it look like they're doing a whole bunch of dividend raises. And that's exactly how this company operates. So them having really high earnings could bring in some inconsistencies and would mean they'd have a lot of cash, the 10% that they're able to keep, not doing a lot for them. So we really do want to see them reinvesting most of the money that they bring in, but only into good opportunities. And that's my one concern with the company is they're going to get to the point where the good opportunities aren't there. So they're going to have to take out a lot of debt because they don't have the cash necessary to get the good deals, or they're going to have to start turning to some bad deals, which will mark the decline of the company, where they have money pits that are pulling the whole portfolio down. Free cash flow yield is really high, as you'd expect. It's real estate. Total assets, they've got some room to grow it based on how they typically perform, raising assets 38% year over year. And liabilities, they also have some room to grow those liabilities. They typically raise those about 33.5%. We do end up with a positive tangible book value that should be growing based on how they typically perform, which is something that we really like to see. Debt to equity, surprisingly, for a real estate company like this, debt to equity is better than a lot of the companies we've looked at recently. We're looking for at least something under 1, the lower the better. 0.73 for a company who is buying buildings and renting them out using leverage is a decent number. And then the ROE down here, nothing super high, but I'd say 3% would not be an awful number for real estate. This has been trending down for them, where of course you're building your equity up in your properties, and the return on that equity, assuming that the rent stays stable, would be declining year over year. So we come down to the fair values or the valuation metrics, and we see that at the end of last year, we had one in the 60s, two in the 80s, and one in the 140s. The balance sheet, of course, is massive here. That's why it gets the lowest weighting, because there's not a whole lot that they can do to unlock that value for us aside from selling the properties that they're already renting them out. So if they were to go bankrupt, that would be how they would pay back investors, selling them off, but they'd probably sell them off at a discount. So this would be a lower number at that point. Then we look at this year's numbers, and almost everything aside from the balance sheet is in the 70s. So 70.63 on the dividend, 70.72 on the cash flows, and 77.4 on the earnings. So that makes me feel pretty comfortable saying that the fair value would be in the 70s for this stock. It does typically trade for a little bit of a discount, so we do have that factored in, and we'd say 67 this year if they're able to hit targets, which they seem to be on track for, would be a decent fair value for the stock. I mean, especially for a 5% dividend, that it seems to be a pretty good value for the stock. So we'd be looking to buy in right around the $57 level, and we'd be wanting to reevaluate the position once it hits 74. And then next year, if they're able to come in on target and trend, we'd be looking for about $1 growth in the fair value, bringing it up to 68, $1 in the margin of safety, and also $1 in the sell price, the reevaluate overvalued price. So that's not incredible growth there. $1 when we're talking about a $67 stock. We're talking about less than 1% growth. So that is a little concerning. Hopefully, they're able to come in higher than that and bring in more growth. We do need to factor in that 5% of that right now is coming from the dividends. So we'd want at least 3% to be coming from growth to hit the 8% typical market return. And that would probably be something more like $2 to $3 in growth rather than just one. So it's probably something they can achieve. We'll have to see how quickly they raise this dividend and how that affects things going forward. We've taken a look at this stock before, so the focus is on these new metrics and the earnings. And I don't know, I feel like I can keep it on the buy list for now. At some point, I would like to do a head-to-head between Vici and Realty Income to see which is the better REIT and cut it down to only one real estate investment trust in that portfolio. And the last thing before ending this video, we can take a look at the CEO's comments. And the CEO says that I'm pleased on the results that our team delivered in the second quarter. Our performance continues to be driven by our diverse and high-quality portfolio of leading clients. Our global pipeline of investment opportunities with favorable risk-adjusted return profiles remains active. During the quarter, we closed on $3.1 billion of investment volume, and we continue to evaluate and expand into new geographies. Our investment efforts were supported by our well-capitalized balance sheet, which was further bolstered through a successful debt euro bond offering in July. In addition, we currently expect over $650 million of net proceeds from unsettled forward sales of our common stock near-term growth to support our near-term growth initiatives. Given our current liquidity position and healthy investment pipeline, we are increasing our acquisition guidance to over $7 billion. Combined with our well-performing real estate portfolio, which finished the quarter with a 99% occupancy rate, our business remains positioned to offer investors consistent cash flows and compelling risk-adjusted returns. So they seem to be okay with how things are running with them. I looked over this. I pulled out the important numbers. If we really, really want to get deep into this, we could look at the actual terms of the loan that they have, lines of credit, and see what kind of interest rates are they paying on their debt. We could look at their changes in occupancy. So we see that there were 131 properties available March 31st, 2023. And at the end of the quarter, on June 30th, there were 137. So a net change of 6. They had 216 lease expirations. 174 of those were renewed. 8 were released to a new client, and 28 were left vacant. They do talk about the theater industry because they do own some theaters. Cinemark represents 1.1% of their portfolio, and they did announce Chapter 11 bankruptcy, so that is going to close down 1% of Realty Income's profits, which they could potentially fill with another theater or see about changing those buildings into something else. So we'll see how that goes. Looks like they had $31.4 million in properties leased to Cineworld and total receivables of $12.9 million. They currently hold interest in 13,118 properties leased to 1,303 clients. So they do have a lot of clients who are leasing multiple properties. And this is in 85 industries. So they are very diversified within their portfolio. And then one last thing that we could take a look at is their guidance. So any changes here, it looks like net income per share, they did lower the bottom bound and the top bound a little bit. Nothing huge, but it looks like they are expecting a lower net income. Their depreciation is down a little bit. They hold their cash adjustments. Looks like they rose their FFO per share instead of a 405 bottom, 407, but the top bound remained unchanged. AFFO, they rose the bottom bound by 2 cents, but they lowered the top bound by 2 cents, so they have a much tighter range there. Rent growth, they're expecting at least 1.25% on same store rent growth. They want over 98% occupancy. That's holding flat. Looks like they lowered property expenses. The top bound a little bit, 0.1%. Income taxes remained flat, and acquisition volume, they did raise $1 billion from 6 to 7 billion. And that's what we're looking at here. So I don't think it necessarily changes my opinion on the company. I'm still leaning towards leaving it on the buy list. It's reaching pretty good values right now. Down below 60, that's good. It's a stock that typically is fluctuating in the 60s, paying out a 5% dividend. So if that's what you're looking for, this might be the stock for you. I don't see a whole lot of growth in it. When you get a company this big and they're issuing shares to buy new properties, you get a very small portion of that value towards your shares and the raise in the dividends. That's why they raise it half a cent a month every couple months. But that's it for this one. So I want to thank you guys for watching. Please like if you enjoyed the video, if you hold the stock. Comment if there are any other REITs that we should take a look at, because we've only really looked at Realty Income and Vici. And I don't own any others. I did fall pretty heavy for REITs early on. And after I got screwed on a couple, I got out. So let me know if there are any that you guys hold. And subscribe so you can stay up to date with everything. And I'll catch you next time.